So Bill Holdings just dropped their latest numbers. And on the surface, they look great. A big beat, right? And the stock, well, it popped a bit, but just a bit. In this breakdown, we're going to dig into why the market's reaction was so, let's call it cautiously bullish. We'll look at what's holding it back and the huge bet they're placing on AI to really kick things into high gear. And that muted reaction, well, it really tells the story here. Take a look. The stock jumped almost 4% after hours. Now, don't get me wrong, a 4% bump is solid. It's good. But for a company that just crushed earnings and announced a new buyback plan, you'd kind of expect a little more fireworks. That hesitation right there is really the core of what we need to unpack. So that brings us right to the big question, doesn't it? Why the caution? The market is clearly giving them a thumbs up, but it's not throwing a party. To really get what's going on with this cautiously bullish vibe, you've got to put two things side by side. The absolutely fantastic quarter they just had, and the, well, kind of bumpy road they're hinting at for the future. Okay, so let's dive in. And first up, we've got to talk about the good stuff. Because before we get to the caution, you really need to see just how well Bill performed. They called it a pivotal year themselves, and honestly, they nailed it. And their Q4 numbers? Wow. Just look at this. They posted non-GAAP earnings per share of 53 cents. The street was looking for 41 cents. That's not just a beat, that's a blowout. And revenue? Same story. Over $383 million when the consensus was closer to $376 million. This wasn't one of those reports where you have to squint to find the good news. It was a clean, solid beat on both the top and bottom line. Yeah, that earnings beat comes out to a 29% surprise. And look, a beat that big is no accident. It's not a rounding error. What it tells you is that these guys have a really tight grip on their operations. They're managing costs like hawks, and that's driving profitability way, way beyond what anyone on Wall Street was expecting. And that awesome Q4 wasn't some one-hit wonder. Nope. It was really the exclamation point on a fantastic fiscal year. I mean, check out these highlights. They hit $1.5 billion in total revenue. They grew their network by a whopping 18%. Their AI tech stopped over 8 million fraud attempts, which is wild. And on top of all that, they generated over $300 million in free cash flow and bought back $100 million in stock. I mean, that's the textbook definition of a healthy, growing company. The CEO, Ren Lacerte, he really put it best. He called it a pivotal year, where they got the job done on both innovation and making money. It was the year that set them up for what's next. But it's that what's next part that has the market tapping the brakes a little bit. All right, so let's make that pivot. We've seen the great performance. Now let's look at the path forward. Because despite that incredible year, the company's own guidance is, well, cautious. They're signaling some headwinds are coming, and a lot of it is stuff they can't really control. And this right here is what's giving investors pause. It's the guidance for the next fiscal year. Now look, core revenue growth around 13.5% and solid earnings per share, that's not bad at all. It's respectable. But, and this is a big but, it's a clear slowdown from the kind of breakneck growth investors have gotten used to from Bill. So you gotta ask, why the slowdown? Well, management is basically baking a few challenges into their forecast. For one, they're playing it safe and assuming their customers aren't going to spend any more than they are now, because the economy's a bit shaky. Then there's the whole interest rate thing. As rates come down, PayPal earns less money on float. That's the cash they hold for customers. That's been a nice little tailwind for them, but it's fading. On top of that, they're seeing some pressure on their take rates, which is the cut they get from each transaction. So it's not one big thing, it's a few smaller things all adding up. Okay, so with all that caution about the near term, this is where we get to the really exciting part. The bull case, the long-term vision. With growth slowing down a bit, Bill is going all in on AI to be their next big growth driver. And we're not just talking about some cool new features. We're talking about something that could fundamentally change their entire business model. So, the billion-dollar question for every investor right now is, how do you get that growth engine revving again? For Bill, the answer is a massive strategic shift. They're moving towards something they call autonomous finance. And the engine behind this whole idea is a technology called agentic AI. Now, this is super important to understand. Think about it this way. This isn't an AI that's like a helpful co-pilot just making you faster. No, this is an AI that's the actual pilot. It's an autonomous agent that does the entire task for you. It doesn't just help with the workflow, it is the workflow. And that is a monumental shift in what they offer customers. Right now, their model is basically do it with you. The software is there to help you. But this new vision, this agentic AI vision, is do it for you. Just imagine an AI agent that doesn't just help you scan an invoice, it receives the invoice, reads it, gets the approval, and schedules the payment, all on its own. That's the absolute game changer they're working towards. Okay, a cool vision is great, but how do you make money from it, right? Well, Bill has a 3-step plan, and it's pretty straightforward. Step 1, get people to actually use these AI agents, drive mass adoption. Step 2, once they're hooked, roll out new subscription tiers. You want the fancy AI, you pay a premium. And step 3, for the really powerful, sophisticated agents, they'll charge on a per-transaction basis. It's a really clear, logical path to turning this tech into serious revenue. All right, let's bring it all home. We've seen the great results, the cautious outlook, and the big AI bet. So what does it all mean for the next quarter? And what's our final call on the stock? So, on the next earnings call, here's what you should be watching for. First, can they hit the high end of their revenue guidance? That's table stakes. Beyond that, keep an eye on how quickly they're using that new $300 million buyback. But the big one, the real catalyst to watch, is any news on their Embed 2.0 partnerships. That's where they're trying to bake their tools right into the systems of major banks and financial firms. It's a huge potential growth channel, so any progress there is a big deal. Okay, so the bottom line. Our final verdict here is an outperform rating. Look, the short-term economic headwinds, they're absolutely real, no doubt about it. But we think the market is getting a little too hung up on that and is seriously underestimating the long-term, massive potential of this agentic AI strategy. What we see is a company that's being smart and careful about the present while building a truly ambitious plan to own the future. And for investors who are willing to be patient, that's a very, very compelling story.
And just a reminder, this is not financial advice.